Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
$70.18. That is the number on the board as of the close of trading Tuesday, February 24, 2026.
Right, on a volume of 896,689 shares traded.
And the velocity behind that move, well, it's undeniable. We are looking at a 143% gain year to date. Over the last 6 months alone, Ultra Clean Holdings, ticker UCTT, has surged 159%.
It is a textbook U-shaped recovery, visually speaking. We have to remember that back in April of 2025, less than a year ago, this stock was sitting in the absolute doldrums at $17.84.
It's a violent repricing, and it forces us to ask a very specific and, frankly, very expensive question. Is UCTT genuinely transforming into a high beta proxy for the AI infrastructure boom, specifically the build-out of 2-nanometer chips and high bandwidth memory? Or, on the flip side, is this just a dangerous momentum trade?
A trade fueled by an RSI, a relative strength index of 74.24, which usually screams overbought, and some very aggressive analyst upgrades.
Exactly. So I'll be taking the position that UCTT is undergoing a structural re-rating driven by their UCT 3.0 strategy and the transition to AI-driven demand.
And I will be arguing that this current valuation completely ignores the massive gap net loss, the reliance on heavily adjusted numbers, and the, quite frankly, existential risks posed by China export controls.
Let's get right into it then. The structural bull case here is that the market is finally discounting the past, and by that I mean the losses you're about to bring up, and they are buying the future of the AI-driven supercycle. You saw the reaction on February 23. There was a narrow earnings miss, a slight wobble in after-hours trading, and then what happened?
It bounced.
The stock ripped higher. Why? Because smart money institutions like Millennium Management, who increased their position by nearly 950% in Q4, and Invesco, they aren't looking at last quarter's noise. They are looking at the 2030 vision. The semiconductor market is heading toward $1 trillion by 2030. UCT has put a very credible target of $4 billion in revenue on the table. This isn't just a standard cyclical upswing. We are talking about a technological inflection point driven by physical AI and autonomous driving.
I hear the narrative, and I know the market absolutely loves a good pick and shovel story right now. But I just don't buy that the valuation should be this disconnected from the current financial reality. You are talking about a technological inflection point, and I am looking at a balance sheet that is screaming distress.
Distress is a strong word for a company sitting on over $300 million in cash.
Is it? Look at the bottom line. Fiscal 2025 GAAP net loss of $181.2 million. That is a negative $4 per share. You can talk about the 2030 vision all you want, but right now, this company is bleeding on a GAAP basis. And let's be honest about why. They took a massive $151.1 million goodwill impairment charge.
Which is non-cash.
It's non-cash, sure, but it is management admitting in cold, hard accounting terms that they overpaid for past acquisitions. They made mistakes. So now, with an RSI over 74, you're telling me the market is rational to price this at 52-week highs? It really feels like the AI label is being used to mask a very messy situation.
I think we need to separate accounting mechanics from operational reality here. That impairment charge, as we agreed, is a non-cash event. It is a cleanup of the balance sheet reflecting the 2024 to 2025 downturn, which we all know was brutal for the entire industry. It doesn't impact their liquidity, and it doesn't impact their ability to execute the UCT 3.0 strategy.
It impacts my confidence in their capital allocation. If they destroyed value before, why should I believe they won't do it again with this new capital? Management claims a non-GAAP income of $47.7 million or $1.05 EPS, but the real numbers show that massive loss. Plus, revenue actually decreased 2.1% year over year to $2.05 billion. Where is this explosive growth?
You have to look at the mix shift. The overall revenue took a hit because of the cyclical trough, but focus on the services segment. Services growth was actually up $10.8 million. And why does that matter? Because the services segment carries a 29.9% gross margin versus the hardware side, which is sitting down at 14.4%. This mix shift is the secret weapon for profitability. As they cross-sell those services, the margin profile expands structurally. They maintained operational profitability with a 5.3% margin, even with factory utilization sitting at a weak 65%. That is resilience.
I just come at it from a completely different angle. You are celebrating a $10 million bump in services when the core business, the product segment, is shrinking. Products still make up 87.6% of their revenue. That is the elephant in the room. You cannot cross-sell your way out of a hardware slump when your factory utilization is running at 65%.
But the utilization is low because the OEMs, the original equipment manufacturers like Lam Research and Applied Materials, were burning off inventory. That burn-off is largely done. We are entering the ramp.
We've heard that they are entering the ramp for 3 quarters now.
And the data is finally starting to support it. Look at the specific technical drivers for UCT 3.0. The goal isn't just for volume anymore. It's vertical integration and moving manufacturing to Asia, increasing their footprint there from 50 to 60%. And on the technology side, the shift to high bandwidth memory, or HBM, is creating supply imbalances projected to last through 2027. HBM involves stacking memory chips vertically. To do that, you need incredibly precise chemical delivery to ensure the connections between layers actually work. That is exactly what UCT provides.
I understand the physics, but does UCT genuinely have a moat there? Let's compare them to their competitor, Ichor Holdings, ticker ICHR. Ichor grew revenue by 16.9% last year, while UCT shrank. Why is UCT trading at a premium when its competitor is actually moving units?
Yes, Ichor grew revenue, but at what cost? They posted a negative operating margin of negative 2.8%. They were losing money on every unit just to chase market share. UCTT maintained that 5.3% margin because of that superior services segment. It is about the quality of revenue, not just the quantity. Furthermore, look at gate-all-around, or GAA architecture. The transistor gate surrounds the channel on all 4 sides. It is incredibly sensitive to impurities. These architectures require the ultra-high purity fluid delivery systems that UCTT builds.
Okay, let's say they have the technological edge. We need to pivot to the risk that I think is being completely ignored by everyone riding this momentum wave, the China factor.
Right, the geopolitical angle.
We have to adjust it. 75.9% of UltraClean's revenue is international, and a massive chunk of that is heavily tied to China. We cannot pretend this is just a footnote. Remember the 2025 class action lawsuit? The stock dropped 28% in a single day because management allegedly hid customer ramp issues in China.
That lawsuit is backward-looking, though.
Is it? Look at the current regulatory landscape. China's Ministry of Commerce issues Notice Number 61, the de minimis rule. If UCTT products contain more than 0.1% Chinese origin rare earth materials, they are stuck in a regulatory nightmare requiring export licenses. This is extraterritorial jurisdiction. If they ship from Malaysia to Singapore, China claims they have a say if that 0.1% is in there. That is an existential risk for a supply chain that relies on these materials for seals, sensors, and coatings.
I acknowledge the risk, but the market has priced this in. The ramp readiness strategy UCTT is executing involves diversifying the supply chain specifically to address this concentration risk. Their expansion in other Asian regions like Malaysia is a direct hedge. And let's not forget the truce announced regarding rare earths between the major trade blocs. It offers a window of stability.
A truce is not a treaty, as 0.1% threshold is incredibly difficult to police in a supply chain as complex as semiconductor equipment. One slip-up, one detained shipment, and that margin expansion evaporates. I think the market is ignoring that UCTT is one new regulation away from a 30% haircut.
Risk is inherent in high-growth tech infrastructure. But let's look at the reward side of the equation. Let's look at the math for the stock hitting $350 by 2036.
The 10-year 5x thesis. Walk me through it. Because getting from 70 to 350 sounds like a spreadsheet fantasy.
It is just operating leverage compounding over time. To get a $15.65 billion market cap, which gets you to $350 a share, you need roughly $6.35 billion in revenue. That assumes they hit the $4 billion target in 2030 and then grow at an 8% CAGR post-2030. As utilization goes from 65% to full capacity, the operating leverage kicks in. If they hit 10% net margins, you are looking at over $600 million in net income. Put a standard 24x multiple on that, and you arrive at $350.
That assumes absolutely flawless execution, and it assumes no cyclical crashes between now and 2036. History shows the semiconductor industry builds overcapacity and then crashes. We just lived through the 2025 dip. If they hit another wall, that 8% CAGR is gone, and I also have to warn about dilution. If they issue shares to fund the capacity needed for that $4 billion revenue target, the share price will not hit $350, even if the market cap hits $15 billion. The pie will be sliced into too many pieces.
Dilution is a factor to watch, certainly, but the cash generation from the higher margin services segment reduces their reliance on equity financing. The demand for AI infrastructure is simply on a different scale of capital intensity. The structural re-rating is justified because this isn't just about selling more valves, it's about being the foundational plumbing for a $1 trillion industry.
To summarize my view, I think we are looking at a show-me trading at a trust-me price. The gap between a $181 million GAAP loss and the pristine AI narrative is simply too wide. The China risk remains a ticking time bomb despite the current momentum and the so-called truth. While I acknowledge the services segment growth, the core product line is too dominant and too vulnerable to cyclicality.
And to summarize my position, the market is a forward-looking mechanism. The $151 million impairment is the past. The $1 trillion semiconductor market is the future. UCTT is the essential pick-and-shovel play for the physical AI age. While risks certainly exist, the technological inflection points of HBM and gate-all-around architectures demand the exact ultra-high-purity subsystems that UltraClean delivers.
It comes down to whether that 143% year-to-date gain is the foundation of a structural climb or just an overextended peak before the next inevitable cyclical downturn.
$70.18. We will let the data dictate what happens next.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.